Good morning, everybody, and on behalf of MIPIM and Cushman & Wakefield, welcome to our panel session this morning on China, investment diversification. My name is John Stinson. I run capital markets for Cushman & Wakefield in Asia Pacific, and I'm based in Singapore. I'm joined by an illustrious group of panelists this morning. On my very left, we have Ms. Yue Tang, who is a partner with the Junhee law firm in Beijing, and Yue specialises in real estate mergers and acquisitions. On Yue's immediate left, we have Frank Koo, known to a lot of you, I'm sure, who's Global Head of Asia for AXA Real Estate, based in Singapore. And on Frank's immediate left, we have Choi Soon Chua, Managing Director of SEB Investment, responsible for global real estate investments, and Choi Soon is based in Frankfurt. This morning, I've got some scene-setting slides on China. Then Yue has got 5 or 6 slides on some regulatory changes in China, which may be of interest to you. And then I'll get Frank and Choi Soon to do a slightly more detailed introduction of their history and their relationship to China and the region. We have a rich history of knowledge on this panel here for China. I then will ask some questions, which I think the responses that I elicit will be of interest to you, and then I'll open it up for questions from the audience. I always like to take the opportunity at these occasions to do some free advertising, so just bear with me for 2 slides. Cushman & Wakefield is represented in 32 offices in 15 countries in the region. Our capital markets group is a group of 90 strong professionals across the region. Last year, by transaction volume, we had number 1 market share in Singapore, number 1 in Jakarta, and number 1 in Shanghai. We did the largest brokered transaction in Singapore, and out of 6 offshore brokered deals in Shanghai, we had 4 executed deals by Cushman & Wakefield investment team in Shanghai. That's it for the advertisement. This is some scene-setting slides on China and how it's moved from being an emerging market, member of BRICS, to being a country where there's many markets within markets. We all know that it's an economic giant. It's the 2nd largest world economy after the US. It has averaged double-digit growth for the last 30 years or 3 decades. Last year it had a GDP just in excess of 7 trillion. It's also the most populous country in the world with a population of just over 1.3 billion. It's been a member of the BRICS for some time, which is Brazil, Russia, India and China, the fastest growing emerging markets in the world. However, it's actually strived ahead of its partners, and particularly its Asia partner in India. It's now got 3 times the GDP of India. It's attracted significantly higher levels of foreign direct investment than India, but most of the investment activity has been concentrated along the coast. In terms of education, it's been a large plank in the government's policy, particularly in this last 5-year plan, which started in 2011. So the statistics are, in 2010, 1 in every Chinese national over 20 had a university degree. In 2020, 1 in 5 will have a university degree. So the investment in education has actually paid off. In one of the UN reports back in 2009, China was voted the most attractive country for innovation. So with urbanisation, it became the beginning. We expect by 2025 there's going to be over 200 cities with a population of 1 million people or more. In 2025, there will be 15 or more than 15 megacities with a population of over 25 million, with 40 billion square metres of space, a lot of real estate. With the rise of affluence, with the rise of education, we've seen a rise in the middle class. In 2015, there will be 150 million households that will join the ranks of middle class that have not been represented in that class before. With affluence, with rising incomes, spending patterns have become more sophisticated. For many luxury brands now across the world, their largest turnover country point is China. There's been investment in infrastructure and transport. Beijing last year became the second busiest airport in the world, and it rose from 9th to 2nd place in a matter of 5 years. It has the largest high-speed rail network in the world today, and it's thought that by 2012, the end of this year, there will be just over 50,000 kilometres of high-speed rail. In terms of roads, in 2010, China equaled the US with 75,000 kilometres of roads. In 2015, that will increase by another 50%. If you look at trade, China has some of the largest container ports in the world: Shanghai, Shenzhen, Qingdao, Guangzhou. So that brings us to diversification, real estate markets within markets. This slide here is the penultimate slide of a research product which will be released into the market in about a month's time. So what we've tried to do is put some metrics behind what makes a market in Asia Pacific hot and what makes it cold. So we looked at 12 gateway markets, and we looked at office product, core office product. So in this metric, we have 3 weightings. One is economic performance, which is macro, one is real estate performance, and the other is overall country risk. So you can see that if each of those weightings had 50% for real estate performance, 30% for economic, and 20% for country risk. Shanghai and Beijing actually came to top 5. It's unusual when we come to Europe to actually talk about Shanghai and Beijing as being core markets. They're often referred to outside of Asia as being still emerging markets. But the theme of this discussion is markets within markets. As you can see on the left in this slide, Shanghai and Beijing, strong rental returns, great fundamentals with low vacancy rates. But right through the Tier 2 and Tier 3 cities, there's many different stories there. There is low rent, low occupancy costs, some very high vacancy. There's a lot of opportunities in both opportunistic and value add. Many will ask, is there too much development? Is there too little development? The fact of the matter is that in most of the China markets, we've had tremendous absorption in 2 years, 3 years since the global financial crisis. One of the big policies of the China government in the last 4 years is to try and keep residential housing at an affordable level. And there has been some regulatory changes which have been quite surgical in the way the market has trended. And as you can see, the market's reacted very, very strongly to any government regulations that either foreshadow or actually changed. So, in conclusion, in the future, we at Cushman & Wakefield believe that there will be over 200 major residential markets in China. There will be over 200 major retail markets, and there's likely to be another 10 major or core office markets. So within that, there is risk, and where there's risk, there is opportunity. So we have the stage set now for core markets. We have opportunistic, we have residential, we have logistics, which is buoyant, we have office, and we have retail. I'm now going to pass it across to Yue to actually, she's got 5 or 6 slides on some regulatory changes which will be of interest to you, and then we'll start the panel discussion.
Thank you, John. Good morning. I'm honored to be here. So today I would like to take a few minutes to update you with some latest regulatory changes, which I believe have either long-term or short-term impact on real estate market in China. First, we look at the land supply policy. China has a huge population, so that's the reason Chinese government adopted the most stringent land supply policy in the world. Starting from 2004, the State Council and the Land Administration released many regulations aiming to intervene into the real estate market from the perspective of land supply. So the objectives of these new policies are very clear. They are aimed to protect agricultural land, to control overheating economy, and to improve efficient use of land. So the major points of this new land supply policy is to increase land supply for low-income housing. So no less than 70% of the total land supply for residential properties will be used for low-income housing. The second major policy is to crack down land stalking and land speculation. The third policy is a local government has to make out detailed planning conditions before they put every piece of land into the market. The third point is they shorten the payment term for land contract and increase the deposit for land bidding. The third policy is reform of the land bidding system. So change the method, whoever offers the most get the land, and implement a comprehensive evaluation method with price only taking 30% of all the factors. So this is the new changes in the land supply policy. Another policy change in connection with the land supply is control for the land supply in second-tier cities by the central government. So this is a picture from the newspaper. It showed why the government want to change the bidding system, because if the land price go high, housing price will also go high. So that picture shows how the relationship between the land price and housing price. Another policy we just mentioned is about strengthening land supply in the second-tier cities. You know, before 2011, the central government only has the right to approve any increase of construction land in 84 major cities. That's all the big cities. And the local government has the power for all the other cities. But starting from August last year, the situation has been changed. So the central government has the right to approve another 22 second or third tier cities if they want to increase their construction land. These 22 cities are mainly located in the East China, in the wealthy part of the China. They include Qinhuangdao, Nantong, Yangzhou, Tongzhou, Wenzhou, Zhongshan, Foshan, etc. This is very well-known cities. This policy change is widely regarded will have significant impact on the land supply in these cities. So under the control of the central government, we expect land supply will become very cautious in these cities. Next, we look at the financing policies. In February 2011, China Banking and Regulatory Commission, CBRC, released a new regulation alerting financial risks arising from real estate investment. First, the new CBRC regulation imposed certain limitations on the financing of real estate development. In order to lower risks associated with real estate development loan, a developer which delayed in commencing development for over 1 year period will be put in a blacklist, and no development loan will be extended to such developer. So that's the first point. The second point is a developer is not permitted to borrow bank loan to pay land premium. That means developer has to pay land premium with its own equity. The third point is under construction project may not be used as a collateral to secure development loan. Under construction project may be used as a collateral, and the land alone cannot be used as a collateral to secure the development loan. This is also to loan the risks for the banking. Second, the CBRC regulation increased the down payment and interest rate for housing loan. The down payment for the first housing loan in 2011, last year, has been increased to 30% for the first housing. And for the second housing, it has been increased to 50%. The interest rate in October last year, major banks in big cities have increased the interest rate for the first housing loan to 1.1 benchmark rate. That's for the first housing. For the second housing, it has been repaid. For the first housing, it was increased to 1.05 benchmark. For the second housing, it has been increased to 1.1 benchmark rate. But the good news is, 2 days ago, just before the opening of the 2 sessions in China, major banks has lowered its interest rate for the first housing loan to the benchmark rate. So we regard this as a gift to the 2 sessions. The third point of the CBRC regulation is CBRC regulation requested to monitor risks associated with the real estate investment trust plan. Starting from 2011, CBRC changed its policy regarding real estate investment trust plan. So in the previous, before 2011, there were only disclosure requirements for the investment trust plan. But after that, it is subject to the case-by-case approval of CBRC. The next regulatory change is to expand the purchase limit to more cities. In 2010, the State Council requested the local government to take temporary measures to impose limitation on residential properties. Since then, around 30 first and second tier cities have released a temporary policy that a household can only buy one house after May 2010. But in August 2011, the Ministry of Housing released a new regulation requesting certain cities which meet certain criteria to adopt purchase limit. These criteria include 2 criteria. First is cities that have experienced significant increase in the purchase price and the transaction volume. The second is cities that in close proximity to major cities that have already implemented restrictive regulations. So up to now, there are 46 cities, including first, second, and third tier cities, which have implemented a purchase limit on residential properties. Purchase limit is a very controversial policy in China now, so the market strongly opposes it. The local government is very reluctant to implement it, but the central government is determined to keep it. So you read the newspaper, you will find out that recently there's some news in Shanghai and Wuhu. The local government relaxed purchase limit somewhat, but such relaxation was canceled very, very soon, even overnight, by the central government. So this indicates that the local government actually has not much say in determining when to cancel purchase limit. It is the intention of the central government that this policy will be continued in 2012. This is the picture. Also shows the housing price is too high, and the government take drastic measures to knock down the housing price. Another regulatory changes is encourage low-income housing. Last year, the local government are under the great pressure from the central government to build 10 million units of low-income housing and 7 million units of low-income housing in 2012. So in September last year, the State Council issued a new regulation, give some detailed guidance and incentives for low-income housing. Those guidance and incentives include increasing land supply. We just mentioned 70% of the residential will be marked for the low-income housing. And increasing investment by central and local government. All the revenues from the public housing fund and 10% of land premium will be used in the low-income housing. Third, increasing credit support for low-income housing by the banks. And fourth, reducing and exempting tax that in connection with the building, selling, and operation of the low-income housing. Because the legal and the financial environment has becoming more and more relaxing for low-income housing, so some developers have switched part of their resources to the development of low-income housing. The last regulatory change I would like to talk about is the foreign investment in real estate. Since 2006, there are not much big changes in the policy of foreign investment in real estate. Generally speaking, a foreign investor is required to set up an entity in China in order to engage in any type of real estate development. It doesn't matter it's developing or it's just buy the completed property and hold the property. So for a foreign investor, whether the entity can be successfully set up and whether the equity of this entity can be converted into RMB is the most crucial regulatory issue. So in June 2010, the MIPIM has delegated its power to approve foreign investment below 300 million to the local government if such investment falls into the permitted and encouraged categories. So in terms of real estate development, residential properties, except villa, and retail properties are regarded as permitted categories. And the luxury hotels and offices are regarded as restrictive categories. For restricted categories, the local government has the power to approve any investment below $50 million. But even if an investment was approved by the local government, it was still subject to the filing requirements of the MIPIM. There are many disadvantages and controversials about the filing requirements of the MOC, but MOC will continue to keep on this policy. So our experience is that even if the local government approved the project, approved the investment, MOC in the filing process may still challenge it. And the basis for such challenge is whether such investment is a long-term investment, whether it is a speculation. I used to argue with MOC officials that all the real estate investment are speculations. There is no long-term investment. But from their standpoint of view, if it's a PE, if a private equity fund was involved as a major investor, they would challenge it and they would ask for more information about it is a long-term investment. So more and more investors have chosen to invest in the development stage of the real estate project in China. Development is more likely to be regarded as a long-term investment. So that's the end of my presentation. Thank you for everyone.
Thanks, Yue. Choi Soon, I might just get you to introduce yourself to the audience and talk about your history in China.
Okay, good morning, everybody. SEB has been, we manage about 15 billion euros of real estate directly globally, and about 10%, so we have footprint in Asia is about 1.5 billion. We started investing into Asia since 2006. And in fact, our first investment into Asia was in China and not in the developed markets of Japan or Singapore. So we actually took the step that our first investment was just, again, by chance and opportunity, and we felt comfortable, in fact, to get into China as our first investment. So since then, we've done 3 investments in Shanghai, 2 office buildings and a residential, which we have since sold and liquidated, and we're actually in the process of looking to get back into the market as we're speaking. Yeah. Mm-hmm.
Thanks, Choi Soon. Frank, would you just introduce yourself to the audience? And I know you haven't invested in China yet, but talk about your role in Asia Pacific, please.
Okay. I come from AXA RIM, and at AXA RIM we have about 60 billion under management, and of that, about 50% is coming from our own balance sheet. So we have about 30 billion US coming from our own balance sheet. We started our Asian operation in 2008, and the goal is for us to have about 20% of our asset under management in Asia in the next 5 years. In China, we have 2 strategies. On one side, we are on core, and on the core side is the insurance companies buying office buildings for their own needs. Obviously, we right now in China, we have about on the insurance side, we have about 6,000 people. So obviously, we do need our own space. On the investment side, on the fund side, we are interested, the asset class that we are most interested in is mid-tier residential. I think, people in the audience might find it strange why we are focused on mid-tier residential, given the fact that prices are continue to correct, and our view is that it will continue to correct another 10 to 15% more. But I think, like what Yue has just mentioned, essentially a lot of this correction is a government policy-driven correction. For us, we think that at some point in time, the government's intention is not to crash the market, but to make it more sustainable. For us, if we look at land prices, which is a big component of development costs, probably about 50% of development costs, we see that land prices have dropped about 50% from 2011. So for us, I think we feel that we are quite comfortable to go into the market despite the fact that we know that residential prices would continue to drop about 10-15%. So just to give everyone some idea, I think in 2009, in terms of land prices, when the government auctioned a piece of land, land would be trading at about 70% premium from the auction price. But today we see that land prices are trading at about 8%. In fact, last year I think 900 sites got aborted because it couldn't reach this reserve price. So for us right now, as a believer of the urbanization, the growth of the middle income, we still believe in residential, and we are looking to buy land sites right now.
Thank you, Frank. In the last couple of weeks, the China government announced an easing that they will require less cash reserves for onshore banks to hold. And I think one of the features of the market in the last 3 or 4 years has been much lower levels of liquidity, which has actually meant that there's been more offshore structure trading rather than onshore trading. With this easing, Frank, do you see any immediate impact to the government looking to increase liquidity onshore in the mainland at the moment?
I think the government has been trying. I think in a way the government has tried to increase liquidity by reducing the bank reserve ratio. I think last month they just did that, and I think as looking at the situation right now, a lot of the developers are pretty cash strapped. So I think it gives foreign investors a lot more opportunity right now to team up with local developers. I think previously when liquidity was abundant, I think it was very, very hard for foreign players like ourselves to, compete with the local developers simply because their cost of capital is so cheap. But now, given the fact that there's a big liquidity crunch, I think a lot of the developers are more in tune to work with foreign investors.
Maybe I can just add up on that point. It is surprising that you could actually provide loans or mass loans in certain situations where we're not in that. But we're looking at some of these situations. But you could theoretically get from interest rates from 20 to 50%. So I think if you are giving a rate of 50% to somebody, it's probably going to go bust quite soon. But but still there are developers who are actually willing to take on that kind of situation and that kind of loan. So it is an interesting time actually for foreign investors to look at China, although still albeit with a lot of risk involved. And if you're going to do that, whether you can actually, there are issues, and probably can better answer that, whether you can have access to the title, you can foreclose if the guy doesn't pay up and so on. But definitely I think those are interesting situations at this stage.
Chui Soon, you have successfully invested in the market and you've successfully sold at a profit. A lot of investors would say a sign of relief and move on to other markets. Would you reinvest in China now? Yeah.
No, we're a big fan of China. So within Asia, China is one of our key strategies. So in fact, there are only 2 countries, and apart from Singapore, actually 3 countries, and we're looking at China, Japan, and Singapore. Singapore is a very small market, but that's we have a team there, but it's just small. anti-cyclical, and we try and do off-market transactions. But China, definitely, I think it's just a big part of the equation. You know, if you want to be invested in Asia, you just cannot ignore China. China is not an easy country, but you know, the opportunities and I guess the returns are there if you understand you know, the country and the makeup. And just again, you know, by numbers, it's just such a big country, and if you look at consumption, you know, 2 or 1%, 5% of the population is, you know, is the size of the population of Germany, if not larger than Germany. So it just, you know, you have a lot of buying power. So if you talk at, you know, just by numbers, it's all a numbers game, I suppose. But having said that, I think, you know, we are keen to invest into China. We look at the first-tier cities, second-tier cities, and the third-tier cities. And I think, John, I think you had a slide on the 12 5-year plan. So if you look at the way the Chinese government plans their economy, it's actually quite interesting. So it's a very detailed and very forward-looking. So, you know, that plan, the 12, that's like 60 years. They started planning, that was even before I was born. Yeah? So, I mean, they actually see so far ahead. And so, you know, they're executing their 12-year plan now. Yeah. So again, you know, they'll have their next 100-year plan. So if you just look at that and reading the 12-year plan or the 5-year plan, I think you can read a lot into what they are planning. So I think from there you can pick up, hopefully, also your investment opportunities. Yeah. Mm-hmm.
Thanks, Choi Soon. One of the advantages of the offshore structure for foreign investors is that there is an audit trail of documentation for due diligence, particularly as buildings trade, as you saw and as you would have used with Platinum Tower, for instance, Choi Soon UA. For the audience, can you recommend any form of risk management, or what recommendations would you give the audience for due diligence when looking at either investing onshore or via an offshore structure?
It's used to say that there is a Chinese way of doing business. So the Western style documentation and the risk management is not applicable in China. So I heard many of my clients said about this, but my experience is that I think it's not necessary to lower your standard only because you happen to have a Chinese partner. There is no Chinese way of doing business. There is only high or low standard for documentation and risk management. So I think if you work hard, that's also the successful cases of my clients. If you work hard enough, you can persuade your partner to adopt your standard of documentation. And this is the first point. The second point is many local developers, especially listed companies, they are becoming more and more sophisticated, and they have a very, very lengthy documentations when they're dealing with investment with foreigners. So their standard is quite international or quasi-international.
You are just on a related point. There's been some concern, particularly as the market increased and post-global financial crisis, prices started to come down again. There's always been a concern about contingent capital gains tax onshore. So how are purchases that you are dealing with, how are they actually evaluating those contingencies for tax when they're purchasing via an offshore structure? Are they actually making a contingency onshore?
I'm not sure if you are talking about the new tax policy in China. It's starting from 2010. So if it is offshore structure, an investor sell the equity of an offshore company, and this offshore company hold equity in a Chinese company. In that case, the mid-level structure will be wiped out by the tax bureau. So this is quite a significant change in the offshore structure, in the tax offshore structure, and investors has the obligation to report to the tax bureau, and the tax bureau will review it. So if you meet certain criteria, in that case, they will regard it. You sell the equity of the Chinese company, and you will pay the withholding tax, Chinese withholding tax. So this is not a contingency. It's a very it's very likelihood for the Chinese tax.
Okay, thank you. Frank, quite often, or in history, people have looked at Asia and particularly China as being an opportunistic play. Then you see the returns on properties in Beijing and Shanghai, and their income returns of 4.5%. They're higher total returns, they're sort of early teens unlevered, and they're much higher when they're levered. Do you think the returns on offer balance risk?
I think for us, on the core side, we are buying for operational use. So we are not really buying it on behalf of the fund. So if we wanted to go core for us, right now in Asia, from an investor's perspective, we prefer Japan and Australia. So for us, we are more on the opportunistic space in China right now.
Okay. Choi Soon, what about you?
Yeah, no, I mean, definitely China is quite difficult to invest into core, but having said that, I think our first investment was actually an office building, was a core investment that we had planned to hold it 10 years, but we actually sold it after, I think, 2.5 to 3 years. And the core investment became an opportunistic investment, and we made opportunistic returns. So I think that surprised us a little bit in terms of, capital growth. So, the way we look at China is, I think a lot of it is actually in the capital growth, and the income component is actually quite minor. But still, there is this income, and it's let's say we just take office. We just give an example. Beijing actually surprised us totally. So, the time we invested in Shanghai, we actually looked to buy in Beijing. But when we price it, I think we, at least, I think all common sense, I think we price it at a certain level, but the market was not giving you that level, and we felt that with the vacancy rate at that time, just before the Olympics, vacancy, they were trying to restrict, they were not restricting the supply, but the supply was like 20%, vacancy rate was 20%, and buildings were left empty. So, logically, you could buy an empty building at, relatively attractive prices. Of course, they were not biting. But, since then, if you look back, today the vacancy rate is like, 3-5% in Beijing. And rents have actually shot up by, 20-50%. So I think that really surprised us. And, in developing markets, I guess in this case, it was the domestic demand that we couldn't figure out. The reason why vacancy rates have fallen so dramatically is the Chinese local domestic companies have taken up all that space, and many have bought their buildings. So that is, a component that is there, but it's very difficult to really figure out if you want to do your research. The Chinese companies just kind of appear overnight and they just take up the whole. So the, demand is there, but it's a tough call to try and project what the real demand, and going forward, would that demand be there? Yeah, but so this is just one story of how we look at office. It's not an easy call. So I guess you have to do a lot of research. Having said that, I think the big numbers tell you, grade A office buildings, total supply is still relatively small. And in Shanghai, for example, total grade A is less than the total supply of Frankfurt, for example. And that's a huge city. So in that sense, I think the results are just showing that, the demand is fitting into the system. So, in China, our strategy, we look at core. We would also look at more opportunistic plays, just like Frank in the residential development space. We're actually looking at that as well, to build to sell. I think the demand is there in second, third tier cities. There's less speculative demand, but real demand. And then turnaround situations. I think that you can actually do quite well in buying less managed. Well-managed properties, and you put in some CapEx, you turn around the building, get the leasing up. I think that's there's still quite a bit of opportunities in that space in China as well. Yeah. Mm-hmm.
I'm going to open up the questions from the audience in a second, but I've just got one question for Frank. Frank, we've seen the changes in government policy in China, where insurance companies are now allowed to invest in assets other than the ones that they occupy. We've also started to see CIC become acquisitive around the world. We've seen Hainan Airlines purchase properties in New York. We've seen them purchase minority shares in hotel chains, NH Hotels in Spain. Do you think this is going to become a thing of the future? Do you think it's going to become more common to see money coming from China investing outside of the region?
I think it would be simply because I think if you look at China, essentially from they don't have enough investable stock in the Chinese market. So I think obviously, there is quite a lot of liquidity in the Chinese market, and because there's not enough investable stock, I think the Chinese would start to look outside China, and we are seeing this now. And when I talk to my European colleagues, we are seeing Chinese coming over, to places like the gateway cities in Europe, trying to buy core assets. I think for them it's both, a defensive strategy and also to diversify. But I think, surely, given the fact that there's limited investable stock, they would have to leave their home country and look for opportunities elsewhere. And I think given the fact that the RMB continues to strengthen, I think that's working towards their advantage. Or the euro and the US continues to weaken against the RMB, I think that's working towards their advantage as well.
Thanks, Frank. Just wondering if there's any questions from the audience. Mark.
I just wondered if you thought of, John gave the stats about how many large cities there are already in China and how many there are going to be. And for both Choi Soon and Frank, how many Chinese cities are there at the moment that you would consider suitable for investing in as a reasonably risk-averse foreign investor?
I think for us, we are, there are a lot of cities, and obviously we go where we have best knowledge and where our partners have good knowledge and good execution ability. So I think for us, we have narrowed down to 2 first-tier cities and 4 second-tier cities. So for us, in the first-tier cities, we are focused in Beijing and Shanghai. Given the fact that the policies, that were implemented by the government took place in Shanghai and Beijing first, obviously corrections are more drastic in those cities. And the 4 second-tier cities that we are interested in is Chongqing, Chengdu, Wuhan, and Tianjin.
Yeah, I think from our end, of course, you cannot ignore Beijing and Shanghai. And if you look at China, you got Western China. So I think Frank mentioned it. So there's Western China, which is growing. It has a huge population. Chongqing has 30 million people, so that's really quite a big concentration. And the government is also driving that. And I think not many people know that, the Silk Route, the old Silk Route, and China is actually building the rail track, actually extending westwards from Chongqing or Chengdu, heading west. So I think that will connect Europe with China, and that will actually open up Western Europe quite significantly in the next few years. And then of course you got Central China, which is relatively undeveloped, but that was the the old Chinese dynasty actually started in Central China. So that will be another another growth phase, I guess, in the next few years for touristic reasons. I think you have been Xi'an and all that, and so I think that would be also it's a relatively poor region, but it still has a very rich historical heritage. And of course you got northeastern. So really in each region we have kind of narrowed down to 1 or 2 cities that we will look at. But at this stage, starting from West China, and we have a small team, but it's again really better to focus rather than to be everywhere. Yeah, but we do our research. It's a top-down as well as a bottom-up approach. Yeah.
Choi Soon, does the amount of development in Chengdu and Chongqing, is that a concern, or do you believe that that's the next part of China that's going to be urbanised, and so we're going to have absorption that will catch up?
Mm-hmm, mm-hmm. Yeah, I mean, there will be risk, but we are pretty positive on Western China. On the residential side, I think the demand is there, compared to, like I said, less speculative demand. On the other hand, there's less HPR or house purchase restrictions, which also encourages buying, which is bad, but I think the government is watching that quite closely. And the intrinsic demand, I think, is there. I think if you look at it, I think they have. Chongqing is going to create, I think, within China, all the cloud-based computing, a big part will be based in Chongqing. So there'll be huge servers that they're actually currently building, and I think they're supporting that technology. Heavy industries is also in there. So I think the intrinsic demand is there. So yeah, I think we're quite positive. There are pockets of dangers, but I guess you have to watch out. Really, you have to go down to the micro level and each sub-market. Yeah.
Can I talk a little bit? Yes, so I would like to advise is that if you choose your investment destination, I think it's better now to avoid the first tier cities. We have a lot of experience dealing with the approval authorities of the first tier cities. It really takes much longer and harder to get approval for foreign investment. The reasoning is that they don't think they need any more foreign investment. Their land price, their housing price is already very high. So I think if you go to the second or third tier cities, the local government will become more friendly, and it's make your life much easier to get approval very, very quickly.
But having said that, I think just to add on Ye's point, there are risks, there are political risks, and I think you guys may have picked up FT yesterday, Posi Lai, the previous premier in Chongqing. I mean, his big article on him and corruption and all that. So I think there are, and struggle for power and all that stuff. So there are risks investing in China. So you just have to be conscious of those risks as well, yeah, and how that may affect your investment strategy. Yeah.
Yeah, I think for anyone that's interested in investing in China, I think a good read is the 12-year business plan of the Chinese government. I think no government in the world tells you what it's going to do for the next 5 years, and the Chinese government is one of the few. And I think by reading, the next 5-year business plan, I think it gives you an indication of, where the Chinese government's policy is going to swing towards, and essentially where, it's trying to develop. I think, obviously it's not cast in stone, but it gives you a good guideline.
It's the great part about a non-democratic government. When they say they're going to build infrastructure and roads and railways, they actually do it. So that's a very dependable part about China. Any other questions? Just introduce yourself, please, Gordon.
Sorry, Gordon Marsden from DTZ. How concerned are the panel and the clients of the panel about the planning regime in China? And sort of two examples, the ongoing supply, notably of offices, commercial space in second and third tier cities. And then in the retail sphere, the idea of investing into a shopping centre and finding other competing shopping centres springing up in your catchment area. How much of a concern should that be for international investors?
Would you like to tackle that one?
I think for us in China, given the fact that policies are changing, I won't say it's changing continuously. For us, our strategy, our advice to investors is still to adopt a asset-like strategy. So I think for us, given the fact that we are in a residential, is both a self-liquidating and self-financing asset. So I think that's the asset that we prefer to be in at this point in time.
Okay, maybe the first question, Gordon. We actually like a centrally planned economy, because I think if the kind of government decides to do something, the infrastructure, they'll build it. So in that sense, we actually find that positive. Like India is the other extreme. Sorry, what was the second question? Oh, right. Okay. Yeah. I mean, that's we are not actively looking at retail, but that's definitely. Many of the foreign investors have not done very well in retail, so it doesn't mean we will do well. And we are not really actively looking at it. But retail, I think if you look at big numbers and all that, it should do well in China. The execution is, I think, the tough part. And if you look at Chinese malls, the cheap, the mass, I think they do very well. And then you got your mid and then high end, and I think that kind of thins out. And I think the market is still not quite ready for that. But I think a good, neighborhood type, I think it will do well in that sense. But of course, the risk of oversupply is there. So in that sense, it is actually quite prudent to deal with the government directly. What's going on, what they're planning, and they don't actually cannibalize your center if you wanted to go into that, which I think in many cases they have done many times in the past. The local government actually could be a competitor to you in whatever you do. Yeah.
Thanks, Joyce. And there was many questions out there.
Thanks. There's actually another question for Frank and Choi Soon. I mean, you both work for European groups and have European investors. How do you convince European investors to seek opportunistic returns in China when arguably they could be achieved in their own markets at the moment, given the distress, and obviously they know these markets better? What do you tell them?
I think for us, currently we see Europeans going for more core investments in Asia. So I think for us, given the fact that we have funds in Japan, in Australia, also we are launching one in China, we see more appetite from Europeans going for core investments in Asia, whereas in in the US and the Middle East, I think where we have investor space, we see them going for more opportunistic sort of investment, and China is a place where they are going to.
Yeah. Similarly, most of I think some of the investors in our group, at least when we talked about China, they would actually prefer that we do core investments, which is tough to do, but we find something, we'll do that. But we have our second value add fund, which takes a little bit more risk, and I think they are fine with that. And again, I think with what's happening in fact, we're seeing the shift in sentiment amongst our European investors in the last 6 months, 3 months. They're actually getting more positive about Asia. I mean, just because I think it's in Europe, it's just a tough area. They actually want their money to be invested outside the Eurozone as well. And I think they're seeing growth there, but careful, they're still careful, cautious. So, rather in the first instance, I think a lot of interest in core money, core investments. But there are, certain groups within our investor base that are also quite keen to put out some money in the value add space as well. Yeah.
Thanks, Choi Soon. More questions?
Cushman & Wakefield, based out of Shanghai. Quick question for Frank. With the insurance companies coming into the real estate market, being given a lot more access, we see them looking around at all sorts of different opportunities. What's your opinion on when this equity is really going to come into play and they're start deploying a lot of their money and buying more core type assets?
I think given the fact that I think this money will come into play at some point in time. I think given the fact that the government policies decides when they come into play, I think they won't come into play anytime soon, given the fact that the government is trying to cool the market down. But at some point in time, obviously, the insurance money would come into play. And, the insurance money in China, at least for us at AXA, is very different from our insurance money in Japan, where, if you look at in Japan, for us, the insurance penetration rate is at about 92%. You have population that are aging, you have continuous liability that are maturing. So for our Japanese insurance company, they are just looking for income. Whereas in China, where a lot of the policy doesn't mature to a much later stage, our insurance company is really looking for return. So I think again, very, very different profile from the European insurance company, where liabilities are an issue, as opposed to in the emerging markets where they don't have a big liability issue, they're just looking for return. But I think to answer your question, at some point in time they will come into play in a big way, but given the fact that the government needs to give them the green light, they won't come into play anytime soon.
John, actually, I have a question for Ye. Sorry, just now before I forget. Sorry if I just jump back. Have you done any litigation? I mean, in terms of if you need to, in China, you have all your contracts in place. I mean, we have not gone into a situation where we need to sue anybody. But if it's that the execution and your foreclosure and things like that in terms of law, is that easy to execute in China?
So, okay, my experience is if your litigation case was handled by the big cities, by the court of the big cities like Beijing, Shanghai, Guangzhou, Shenzhen, it will be more easy to enforce it. If it is in a small town, in a small cities, So at that time, connections will have very important part, and it might be very difficult. So I would like to go back to the question that gentleman raised about insurance. I read in the news that the former chairman of China Life Insurance Company, he sent a proposal to the NPC this week that requesting the government to allow insurance company to invest in the social housing development. So I think this is considering the background of this person, he has very strong official background. I think this is a very clear signal that in the near future, probably insurance company is not allowed to invest in development of residential properties. But in the near future, it's very likely it can be allowed to invest in the low-income housing development.
Thanks, Yue. We've only got a few minutes left. We'll get back to questions in a second, but I've got two questions, one for Choi Soon and one for Frank. Choi Soon, after your experience with investing, successfully investing in China, if you think in terms of if I knew then what I know now, is there one thing you'd do differently?
Yeah, that's a tough question. Well, I guess we wouldn't actually do anything differently. It's just China is an interesting country, and it offers you a lot of opportunities. So really, I think just understanding the cultural mindset and what they're trying to achieve, and I think if you can kind of meet those goals together, which I think you could in many instances, they understanding you and you understanding them, I think that you should be all right in the long run. Yeah. Mm-hmm.
And Frank, yours is equally difficult. If you could pick one city and one sector that's your favorite pick for China as an investment destination, what kind of returns do you think you could offer investors?
Again, for us, we are in the mid-tier resi. So I think in the mid-tier resi, we are hoping to achieve returns of about 20% to our investors. So that is the sort of returns that we are hoping to achieve. And we are essentially, again, focused on those 6 cities that I mentioned, 2 first-tier and 4 second-tier cities. So on the blended side, we think that we can achieve a 20% return. For us, given the fact that we are doing it through a fund, we think that diversification is important. So we warned that, we would try as much as possible to try to diversify as much as we can, rather than just going to put all our bets in one city.
Okay. We've got time for 1 or 2 more questions. Okay, thank you. Any closing remarks from Choi Soon or Frank or Yue?
Yes.
I thought you might like.
Okay, my last remark is I would like to bring the attention of the audience to I think the most important trends in real estate market in the next couple of years. I think we have to pay attention to there will be big changes in the land supply market. So currently, land supply market was monopolized by the government. In this market, there is only one seller, that is government. So that explains why the land price go rocket high. So this result to the housing price go high. But there are some policy change at the beginning of this year. So from January, Shanghai and Beijing has some pilot policies that permitted, rural farmers which are represented by the village committee to lease their properties, to lease their land, and collect rental. So I think this is the first stage. The rural land can go to the market. This is a great deviation from the current land law. So in the future, land law may have some changes, and under certain conditions, part of the collectively owned land, we call it, this land are owned, collectively owned by the farmers. Part of them may go into the market, so farmers can benefit from the urbanization. They were excluded from urbanization for 20 years, and there's a lot of complaints. It's unfair for the farmers, but the situation may change. So the land supply market may get more player. I think this is a very important trend.
Thank you, Yue. We've run out of time, so I need to close the session. And just before I thank the panelists, MIPIM have asked me to advise you that MIPIM Asia is now going to be held on the 7th to the 9th of November in Hong Kong, which separates it now from MAPIC. So it was conflicting with MAPIC previously, which made it hard to attend both. But it's from the 7th to the 9th of November in Hong Kong. Thank you to Yue, to Frank, and to Choi Soon. You've been wonderful panelists. If I could ask you to put your hands together to thank the panelists.